retail investors in the U.S. are going to be buying gold, but they're going to be buying it at much higher prices. They're going to be buying silver too at much higher prices. This is a de-dollarization. The dollar is going to go down. I mean, today the dollar is down by over 2% against other fiat currencies. It's one of the biggest moves down in one day in the dollar that I can remember. I think it is. I mean, I think there's no question about it. That's what gold's telling you. I mean, what are central banks doing when they're buying gold at $3,000 and not buying treasuries? They're saying that we'd rather own this metal than get 4.5% yield on U.S. Treasury. So they don't trust the treasuries because they don't trust the dollars. So they want to own gold. And this is a process that is still early and has a long way to go to play out.
Good evening and welcome to the Economy Express, your go-to source for sharp insights into global markets, precious metals, and macroeconomic shifts. Tonight's spotlight falls on a powerful and urgent message from well-known economist and financial commentator Peter Schiff. In a recent appearance, Schiff issued a critical alert to investors worldwide, stating that panic buying of gold and silver is already underway, and that retail investors may soon be left behind, buying at much higher prices as the dollar declines and inflation rises. This isn't just a forecast. Schiff says this is already happening. A major global shift is unfolding, a move away from the US dollar and toward hard assets like gold and silver.
$3,100. We're right near record highs. We set that record high last night, but gold's going up. It's going to keep going up. This is de-dollarization. It's just the central banks that have been driving it up. We haven't even gotten the real investor demand yet. That's coming. Retail investors in the U.S. are going to be buying gold, but they're going to be buying it at much higher prices. They're going to be buying silver too at much higher prices. This is a de-dollarization. The dollar is going to go down. I mean, today the dollar is down by over 2% against other fiat currencies. It's one of the biggest moves down in one day in the dollar that I can remember. One of the biggest ever. And this is just the beginning. So many people were predicting that the tariffs would cause the dollar to go up. And they thought that would take the sting out of the tariffs because, yes, we'd have to pay the tariffs, but we'd get to buy the foreign goods cheaper with our higher dollar. Well, instead, the dollar is falling, and that's going to augment the damage done by the tariffs. So not only are Americans going to have to pay tariffs on what they import, but what we import is going to cost us more because of the weak dollar. Well, right. Gold is just noise. It's just a bunch of trading going on today, the shakeout. Bonds are rising today, but I think that's temporary. I think bonds are going to fall because inflation is going to erode away their value, and a reduction of demand due to a weak dollar is going to lead to lower bond prices. And of course, as the U.S. economy goes deeper into recession and we get larger budget deficits, that increases the supply of bonds to sell, and we have fewer demand for those bonds. Meanwhile, what no one's talking about is over the next 4 years, about 26 trillion of the 36 trillion national debt matures. So all that debt has to be rolled over. Who's going to buy that? So bonds are going down. The only thing that's going to stop that is the Fed going back to QE. But even that'll be temporary because that will create even more inflation, which is the worst thing for bonds. I think there's no question about it. That's what gold's telling you. I mean, what are central banks doing when they're buying gold at $3,000 and not buying treasuries? They're saying that we'd rather own this metal than get 4.5% yield on U.S. Treasury. So they don't trust the treasuries because they don't trust the dollars. So they want to own gold. And this is a process that is still early and has a long way to go to play out. They're down today because a lot of people are also talking about a global recession because of these tariffs. And I think there's going to be a big recession in the U.S., but I don't think it's going to be global because none of the world's factories are going to disappear. They're all still going to be there. And they're still going to sell stuff to America, just not as much as they did. So what does that mean? That means they have extra stuff to sell to consumers in other countries. And as those currencies are rising relative to the dollar, those consumers are richer anyway, and they can afford the products. So I think the world is not going to have a recession because of this. I think it may even have a boom because, what they have to do is very simple. They just have to find new consumers. And there's billions of people around the world that are happy to consume. Anybody can consume. But what America has to do is build factories out of nothing. So, because we can't consume if we don't produce. And so starting to produce what we haven't produced is much harder than consuming what you already produce. So we're the ones that have the rough road ahead. We're going to be enduring the recession. So I think selling commodities based on fears of a global recession are wrong. The U.S. is going to have a recession, but our loss is going to be the world's gain. And so I think demand is going to be very robust for commodities around the world. Even if it's diminished here in the U.S., it's going to be a lot higher outside.
We begin with the central theme of Schiff's message, the de-dollarization of the global economy. Schiff points out that the US dollar recently suffered one of its steepest one-day drops in recent history, falling more than 2% against a basket of other fiat currencies. That's a major move, and it signals something deeper. According to Schiff, central banks around the world are sending a clear message. They are losing confidence in the dollar. They're selling off US treasuries, even with yields as high as 4.5%, and instead buying gold, lots of it. Why? Because they no longer trust the long-term value of the dollar. He cites data showing that central banks' gold holdings have risen dramatically.
Putting tariffs on nations that don't even have tariffs. And the tariffs that he's imposing are way out of proportion to the tariffs other countries have. Because where he's getting these ridiculous numbers is he's come up with some, BS formula that basically claims that any nation's surplus with us is the result of tariffs, even if they don't have tariffs, or even if the tariffs are so low that it barely makes a difference. So when he says, Europe has 38% tariffs, so we're going to put 20% tariffs on. Europe is maybe 4% tariffs. So what we're doing is not reciprocal. It's pure protectionism. I think it's illegal, but he's doing it anyway. But that's his goal. The goal is not to raise revenue. The tariffs are too high. The goal is protection. But I don't think they're going to work. I think they will raise some revenue, a lot less than they expect. I think that's because Americans are going to pay these tariffs. But a lot of Americans aren't going to pay the tariffs because they're not going to buy the good. I made fun of Jerome Powell almost a year ago when somebody asked him about stagflation, and he kind of laughed it off and he said, I don't see the stag, I don't see the inflation. And I said, well, he's obviously blind. And my prediction was that comment about no signs of stagflation would go down in history with subprime is contained and inflation is transitory, because he was completely wrong. Not only is this stagflation, but it's recession, severe recession, and high inflation. It's going to be far worse than anything we had in the 1970s. When people say, this stagflation, it's not like the 70s, they're right. It's way worse than the 70s. The tariffs hit right away, right? But the tariffs aren't paid until the goods are imported. And if you noticed, our trade deficits in the U.S. for the past few months have been off the charts. And so what I think is that a lot of companies saw the tariffs coming and they ordered some inventory. So they have to work that inventory off first. So those products can be sold without the tariffs. Now, I think they will raise prices somewhat because they realize that this is their last chance to make money. Because once they run out of those goods, they have to pay the tariff on the new goods, and their customers probably will be priced out of the market, a lot of them. So you'll start to see some initial increases in prices, but it won't fully hit until they run out of stuff. And, there's going to be a mad dash. I mean, some people are going to rush to the stores and, they're going to buy new sneakers, for example. Maybe they'll buy 3 or 4 pairs, knowing that, they're going to wear out. They'll want to get another pair they're going to wear out because all those sneakers are going to get so much more expensive. So some of these companies, could see a rush of sales, now until they use up what they got. And then their business is going to dry up, substantially. See, what's been happening is we create inflation, printing money. We export it to the rest of the world, and they ship us the stuff that they make. So we have goods to buy and the money goes abroad. And so that keeps prices down and we get more stuff. Then the foreigners take the dollars they earn and buy our bonds, buy our stocks. That gives us lower interest rates and a higher stock market. So we get wealthier on paper, we get to borrow cheap, and we get all kinds of consumer goods we didn't produce, and they're low cost, right? What's going to happen now is all that inflation is now going to move from Wall Street back to Main Street. We're not going to have as big trade deficits anymore. So we're not going to be able to export as much of our inflation. It's going to stay here. We're going to have more money chasing fewer goods. So a big increase in prices. Foreigners are not going to buy as much U.S. stocks and bonds. So we get a lower stock market and a higher interest rate. So that's the reverse of what we've been enjoying, right? And so it's going to be the worst, thing for Americans because they're going to be getting poorer financially as their cost of living is skyrocketing. And many Americans are going to lose their jobs. So we're going to go through the worst economy in modern memory. Now, I don't think anybody alive today has seen an economy that's going to be as bad as this one. Now, it may get better eventually. Maybe we get the benefits of AI and stuff like that. But in the short run, things are going to get very, very bad. Yeah, and that's horrible for the Republicans because, Trump just blew them up. I mean, the Democrats were in disarray. The party was really in shambles, and this is going to galvanize them because Trump is going to be the villain that did this. They're going to be able to say he inherited a great economy, which he didn't, but then he destroyed it. And the Republicans are going to be out of Congress in the midterms. I mean, the Democrats are going to get...
Since 2006, global gold reserves have increased by 200 million troy ounces, totaling over 1.16 billion ounces today. Much of that growth has come from China and Russia, whose combined purchases make up nearly 60% of that increase. At current gold prices, those reserves are valued at a staggering $3.65 trillion. This trend isn't temporary. Schiff argues that gold is evolving from a short-term inflation hedge to a permanent piece of central bank strategy. It's not just a commodity anymore, it's a currency alternative. And while central banks have already made their move, Schiff warns that retail investors are next. He says the average American investor hasn't yet joined the gold and silver rally, but when they do, they'll be late to the party and paying much higher prices. His message to viewers is simple: act before the masses do. But the dollar's decline isn't just due to inflation or gold buying. Schiff points to U.S. trade policy, specifically tariffs, as a major contributor. He argues that the Trump-era tariffs intended to protect American industry have had the opposite effect on the dollar. According to classical economic theory, higher tariffs should support a nation's currency. But Schiff notes that the announcement of new tariffs has actually weakened the dollar, making imported goods more expensive and fueling inflation. That, in turn, is putting even more pressure on consumers, who are now paying both higher prices at home and higher costs on foreign goods. Schiff warns that this could lead to a serious economic downturn in the United States, and it doesn't stop there. Schiff predicts major trouble in the bond market as well. As inflation rises, bond yields will need to climb to stay competitive. But demand is falling. He highlights a looming crisis. $26 trillion of U.S. debt is set to mature over the next 4 years. That debt needs to be refinanced, but buyers are scarce. If the Federal Reserve steps in with more quantitative easing to absorb the excess supply, that will only push inflation even higher. Schiff calls this a no-win situation. Either the Fed lets yields rise and crashes the market, or it prints more money and destroys the dollar. And while many fear a global recession, Schiff sees things differently. He believes that while the U.S. will suffer economically, the rest of the world may benefit. As the dollar weakens, other currencies gain strength. This means countries with manufacturing capacity, particularly in Asia, will shift their focus from U.S. consumers to rising middle classes in other parts of the world. Factories will still produce goods, but they'll sell them elsewhere. Schiff calls this the beginning of a global commodities boom. With billions of consumers worldwide ready to spend, demand for raw materials, energy, and metals could rise sharply outside the U.S., even as the American economy contracts. And then there's the domestic outlook. Schiff warns that the inflation we've been exporting for decades is coming home. For years, the US ran up trade deficits and printed money, while other countries shipped us goods and reinvested our dollars into bonds and stocks. That kept prices low and interest rates stable, but that dynamic is changing fast. Now foreigners are pulling back. They're buying less of our debt and fewer of our stocks. As a result, inflation is no longer being absorbed by foreign economies. It's staying here, on Main Street. That means higher prices, shrinking real wages, and a lower standard of living for American households. Schiff's final warning: the U.S. is headed toward stagflation, recession with high inflation, on a scale worse than anything seen in the 1970s. He says Fed Chair Jerome Powell's past remarks downplaying stagflation will go down in history alongside other famous blunders like subprime is contained and inflation is transitory. Schiff believes the economy is headed for the worst downturn in modern memory. Massive job losses, soaring prices, a collapsing bond market, and a falling dollar. These aren't just predictions. They're already starting to happen. As for politics, Schiff says this economic crisis could reshape the balance of power. He believes Trump's policies may end up pushing voters toward the Democratic Party in 2025, handing them control of Congress. So what's the bottom line for investors? Peter, Schiff's warning is not subtle. The age of dollar dominance is ending. The world is moving toward hard assets. Gold and silver are becoming the new safe haven, first for central banks and soon for the masses. If you're not prepared, Schiff suggests you may find yourself buying at the top, or worse, watching from the sidelines as your purchasing power evaporates. This has been your economic bulletin from the Economy Express. Stay alert, stay informed, and stay ahead of the curve. We'll continue tracking this story and bringing you updates as global markets evolve. For now, thank you for tuning in. And don't forget to subscribe for more financial intelligence, right here on the Economy Express. Would you like me to prepare a YouTube description, tags, or a high-conversion title and thumbnail text for this video as well?
Welcome to Economy Express, your go-to destination for all things economics and finance. Whether you're an experienced investor, an inquisitive student, or just someone who wants to stay ahead in today's ever-changing economic landscape, you've come to the right place. Now, let's get into the details of our news.